Joining us here at Post 9, Alan Gould, Loop Capital's managing director, has a buy rating on both Netflix and Disney. Alan, good to see you. Let's start with Netflix.
Sure.
Subscriber growth, obviously, surprise to the upside. Can they keep it up?
I think they'll keep it up for a while. I mean, I think this year is going to be unusual. They'll probably be close to 25 million sub ads this year. There's obviously a little bit of a pull forward with the password sharing crackdown. It'll keep going for a few more quarters, but we have them down to about 15 million next year. The key thing, though, is with this larger sub base, it helps ensure that they're back to a double-digit revenue growth.
And that is what you would expect for some time, then. So
yes.
It's a growth stock yet again.
Yes, it is.
And therefore deserving of a higher multiple?
I think so. Yeah, I think the stock deserves to be re-rated in here. You've got two things that are happening. One, they've sort of cracked the code on the borrowers. And secondly, the environment's getting better for them. They had irrational competition. Pricing was too cheap by all the competition. You know, the competitors are raising prices. There's less demand for content, so content should cost Netflix a little less, or it's not going to be going up at the same rate it was. And then I think there's going to be inevitable consolidation in the business. You know, the traditional guys in general are losing too much money. So 2 or 3 of them are going to have to merge or drop out of the business, which should make it an even more rational environment.
Not that Netflix would be a buyer.
Netflix won't be a buyer. I mean, Comcast, your parent company, will NBCU merge with Max? That's obviously been speculated. What happens to Peacock? Paramount Plus? You know, there's got to be some consolidation. They all can't continue to lose the money they've been losing.
Are you struck by things they're doing at Netflix that they once said they would never do? Advertising, even passwords to some degree. Now it's sports. We'll never do that. Are the U-turns creating a pattern?
Yeah, I mean, now they say never when they talk about these various things such as sports. But, I mean, it makes sense. They just have to evolve with the times.
What about the strike? Do they have the pipeline? I mean, clearly it helped cash flows this quarter, but going forward, do you have to start worrying about subscriber growth in the face of lower content?
Yeah, I think, Sarah, you do. I mean, the strike is affecting everyone. If you look at it, from the time the writers went on strike to today, it's about 5.5 months. So the writers are back, but the actors are still on strike. And it sounds like they're at a pretty big impasse right now. I mean, Netflix's content purchases are down 30% year over year. This last quarter was pretty low, you know, and I don't think Ted is just giving us a line. I think he really does want the strike to be settled. It's going to start affecting 24 and 25 release slates. And I think to some degree, short-form video, TikTok and Reels, which has been so strong, is probably gaining share as there's less compelling product on all the streaming services.
Alan, in the brief time we have left, I mentioned Disney. What did you think of that 8K? Anything we learned there or that you learned that goes against what you might have expected, for example, from the financial performance of ESPN?
I think 2 things we've learned. I mean, so ESPN, if you break out the domestic ESPN and break out ESPN Plus, is about a 26% margin business. It's about $3 billion of operating income last year. It was actually a little bit less than I was anticipating, which means a little more goes to either ABC or the other cable networks. The other thing that came out is ESPN Plus lost about $400 to $500 million in each of 21 and 22, lost maybe $150 million for the first 9 months of 23. Yeah, we knew there was something because there was a capital call to Hearst on that one, but yeah, we now see exactly what those numbers are.